Okay, well, we have another property here that we're going to look at, and this is actually in Kitchener, Ontario. It is 17 Hilda Place. So essentially what we do here at the Cashflow Analyzer is we just analyze properties across Canada, the US, and see if basically if we can find some profitable cash flow deals. Now, we are primarily looking on realtor.ca, .com, LoopNet. Usually those deals are not the greatest deals, I'm just going to be honest with you. So the best deals are off-market deals, even wholesalers, they can provide great deals. But we are going to do is in the future, we're going to look at some of those deals as well. But just to make it simpler, we're just going to go through realtor.ca right now. We're going to look at this place in Kitchener. And it's actually a pretty good price, 715, but it is only 2 bedrooms, which is only two units. Okay, so let's go into this. Okay, so just going to scroll through here. It looks like a really relatively nice property. I always like to look at the pictures prior. So let's see here. All right, it's actually nice look. It's a little older, the house, but it looks like it's well maintained. Nice kitchen. Just gonna scroll through. Very nice place. Okay. Um, I believe that's the basement. Yeah, basement's super well done. Usually you don't see that. This is like I think the second bedroom, the loft, and actually it's really nice. I'm going to show you this actually is the washing machine is actually in the kitchen, which is a little weird, but um, this is, I guess, is the way they've accommodated some space. So this is some parking in the back. It's really nice. It's this unit here, I believe. And look at the water. So I'm going to show you an aerial view. It's really, really close to the water. It looks like it really be beautiful in the summertime. So this is actually a really good unit, a good property. So we're going to go through here. We're always going to read the description. It gives us information to evaluate this property. So at 17 Hilda Place in Kitchener, it's a legal duplex, and it's about 2,300 square feet, 2,400 square feet. Uh, let me see here. They just give you suggestions. You can live in one or use one as an Airbnb if that's something you want to do too. We don't really deal with Airbnbs here. I mean, that's an option that we could present in the future as an Airbnb to see, roughly how much money we can get if we rent out one of the units. Okay, so that's going to be something coming up in the future. Right now, we're just going to look at is if we're renting both units. Okay, so let me see here. Located close to public transit, downtown Kitchener, which is great. And updates have been completed in 2002, including new kitchens. So for some of the pictures, it does look like they have been renovated. New ductwork in the front and the furnace. Exterior has been treated to full replacement of the roof. Wow, okay. Easy draft, so they have a lot of new upgrades, which is great. The property checks all the boxes for solid investment property. Okay, so the main floor unit, Unit B is leased for $2,100 per month, plus hydro and 50% of the gas. Okay, so main floor Unit A has a potential rent of $2,100. Okay, so what we're doing is we are just going to use these rents for an example. So we're going to come over here. We're going to add this is the cash flow analyzer. So let me just spread that out so you guys can see, give you a better idea as to what it looks like. This is the full cash flow analyzer. There's two opportunities to put two properties on one sheet. Okay, and so as we go through it, I'm going to show you basically all the features on this on the analyzer. Now you can secure this analyzer if you want, and it's located at cashflowanalyzer.ca. Okay, so if you just if you go to this link here, Guaranteedcashflow.ca, that's the URL, and you can pick this up. Okay, so this is going to be probably the easiest analyzer that you can possibly use to just gather information as to see if the property can cash flow. And then once you decide that it does cash flow, and then you go on to the due diligence stage. Okay, where you analyze the deal a little bit more further. You're going to reach out. First of all, what I want you to do is you're going to reach out just to confirm. I mean, this information is here. It says this is how much it's leased for. But you always want to reach out to the agent. Okay, so in this case, it's Mark Benjamin's. So you're going to reach out to him, and you're going to ask for the OM or the P&L, which is the profit and loss, and the rent rolls. So usually this is only 2 units, but if there was like 10 units, 20 units and above, you're going to definitely want to get that, okay? Because you obviously want to make sure that what they're saying here is legitimate, okay? So we are going to trust them right here, and we're going to use these numbers. Okay, so let's put in the property price. So I like to do is I always like to copy the address, because when you analyze so many deals, you kind of forget, right? So you're going to put in here, you're going to just copy the address from the listing, you're going to paste it into here and hit enter. So now we know which one we're doing. And if you want, you could just take a picture. You just take a picture, a screenshot of the image, and you can add it to here as well. We're not going to do that right now, okay? Just because it's a little too time consuming. So we're going to just take this number, which is 715. So the price of this property is 715,000. So we're going to put a down payment of 20% right off the bat, okay? You can go work your way from 5% up. Minimum is 5%, but usually to get financed in today's market, you're going to need you would probably require about 20%, okay? And it's also going to help with your cash flow, which you'll see in a minute. Okay, interest rate, I'm looking at I'm just going to average out at 5%. It could be more, it could be 6, could be even 7, okay, in this market. But let's just put 5 because there's a potential of securing this interest rate. I'm also a mortgage broker. So what to do is if you find a deal that with the cash flow analysis that you think is that cash flow is positive, send it to me. We'll book an appointment. In the link below in the video here, you're gonna have a link to my calendar. You just book a call with me. When you find one, we'll sit down. We'll go on a Zoom call. We'll sit down and we'll look at analyze the numbers to see if you did it right, and I'll give you some suggestions. And if it's something that you want to do, and then we move forward and we go basically to the next step, and that is getting pre-approved for this property, right? Okay. So let's just move on here. So basically the insurance, we're gonna leave this here. So this is 2 units. This is in Ontario, and this is basically these drop downs here basically tell you if you're a first-time home buyer, if all people are first-time home buyer, yes. If none of them, or if maybe one of the 2 parties is a first-time home buyer, you're going to click that, and it's automatically going to calculate your closing costs and land transfer tax for you, depending on what province you are. Now this is the Canadian version. But including also we have a pro version, and within the pro and in the standard version we have a US version. Okay, so we don't have those options here, okay, as the drop downs, and there's different other specifications in terms of expenses in the US version as well. So we're working off the Canada right now. It's very similar, just a couple different features are a little different to accommodate US clients. And so we're going to come down here. Okay, so basically right now we're looking at a 20% down on this property, about $3,000 a month in mortgage payments. So what do we go back here? We're going to go back to the description. So it does have here the upper floor unit is and there's 2 bedrooms, right? So they're basically 1 unit apartments. So basically according to this is 2,100. So we're going to go 1 bedroom. So if you look over here on the left hand side, I just highlighted it. You're going to type in how many bedrooms. So it's 1 bedroom. You're going to click over here to the other side, and you're going to put in 2,105. It automatically calculates it for you. And then what you're going to do is the other one is actually said it was the vacant main floor unit, which is also going to be 1 bedroom, has the potential of rents of 2,100. So we're going to put the same thing. We're going to put 2,105, 2,100. This makes not going to make much of a difference. 2,100. And hit enter, but we have to put 1 in here. Oh, sorry, we're gonna put you know what we're gonna put this 0, and we're gonna make this 2 bedrooms because they're 2 1 bedrooms, right? And there you go, hit enter. So automatically calculates the 2 bedrooms together. Okay, it puts it in here. We are gonna put a vacancy. Okay, I mean for 2 units, vacancy is a big money, right? So if you don't have a unit vacant, if you have a unit vacant at any time of the year, you're losing basically $2,000 a month. So it should be actually 50% of vacancy, okay? But if you do that, then you'll never make a property cash flow, okay? So we're going to put in 5% for now. So 5% gives you about 2,526. So it really only is going to cover you about 1 month's rent, right? So in reality, you should actually put more. Let's say even put 10%. So this is going to cover maybe 2.5 months, okay, of rent in the event that there is no tenant. But I'm going to show you a really cool trick a little later that you don't even have to worry about this, okay? So this is how much income is bringing in per year. This is how much is bringing in per month, okay, on a monthly basis. And this is how much, this is the gross potential minus your vacancy. and which leaves you with 45,468. So that's on a yearly basis. So now we have to move over to the expenses. This is very, very important. Oh, I almost forgot. Don't forget, guys. So what we're gonna do is you're gonna go put in a number of units. Okay, so this is important, which will help calculate the other numbers a little later. Market cap is very important too. So what we're gonna do is I've created this guide, and when you get the cash flow analyzer, the pro version, you will get this with it. And basically, it's every U.S. state and every Canadian state. And basically, it gives you a breakdown of what they are. Okay, so so in this case, is Kitchener. We're looking at a 4% market cap. Okay, so we're gonna put in 4% here. Oops, wrong section. We're going to tap here. Make sure you put 4%. So we need to put them in as many units, because what happens as soon as you hit enter, it automatically calculates per door. So it's going to cost you $357,500 per door, which is a crazy amount of money for per door. But you will see as we go on how we can navigate this. Okay, so once you put the amount in, the purchase price, it automatically calculates the taxes and insurance for you. You don't have to do it, okay? But we use a rule of thumb, which is a 1% for purchase price for the taxes per month, and the insurance is 0.007 of the purchase amount of 715. So you can use these numbers. So basically what you do is just going to copy this and paste it into the blue. Everything you see in blue is what you fill out. You don't touch anything else, okay? So, and then from here, you can copy or paste it in here. And what I like to do personally is sometimes if I don't have enough information, because we don't really have enough information here, right? In terms of other expenses. So what I'll do is I like to put in a percentage, a manual percentage. So on average, like on an apartment building, you're looking at about anywhere between 35% to 50% in expenses. Okay, but this is 2 units, right? We're talking about 10, 20, 30, even higher. You're looking at, it could be 35 to 40 to 40 to 50%. 2 units, a lot of renovations have been made, as it indicates in the description here. So what we're going to do is we're going to make it less, right? Because it doesn't make sense, because we don't need to put 35% expenses, okay? So let's say we're going to put 25%. So now we have a maintenance and repair. So we always, by default, this is what it puts into, but we can remove this, and I'll show you how to do that. So it's basically 5% of the rent. So it's $211 a month. I think it's reasonable, $211 a month. I would leave it, because anything can happen to the apartment. You need to fix this. You need to call a handyman to do that, and so forth. So we're going to leave that in. So right now, monthly operating expenses is $1,263. So if we scroll down here, total income from the property is 45. Total operating expenses is 15,000. So we're having a net operating income of 30,000. However, let's scroll over here. Is it cash flow positive? It is not, right? Per year, it's in a deficit, and also in the monthly is in a deficit, which means we have to either do one of two things. We have to either reduce the expenses or increase the income. So we go to our patented cash flow maximizer. So I've created this, and this is basically the things that you can adjust to improve the cash flow of the property. And so you always want to go through this essentially. Now, this is only offered on the pro version of the cash flow analyzer. Just wanted to give you a heads up on that. All right. So we're going to start off with the increase the income. So raise rents. Okay, let's raise the rents. Another thing I want to do here is, what I like to do is I like to use what is the average cost. So for example, let's move this over. We're going to move this over. What is average cost? Okay. So simple Google search. Okay. You're going to go, what is average cost in Kitchener, right? So we're going to Kitchener, in this case, it's Ontario. Enter. And we will do is we like to use Zoomer. This is pretty accurate, I think. So we're gonna hit here, Zoomer.com, and outcomes. What's the average prices in London? Sorry, it's supposed to say Kitchener. It's just loading. Sorry, it takes taking a little slower than normal. Probably because I have a lot of stuff open. Okay, so no, I don't know why it's not saying that in London. It didn't change. Okay. sure you hit enter. There we are, Kitchener. So it didn't pick up. Okay, so from here, so there are one bedrooms, right? So look at this. One bedrooms, 1845. That's the average one bedroom in Kitchener. So and now if we go back to the listing says they're currently getting 2100 roughly. So it's actually more than the average, which is great. So we're going to go with those numbers, okay? So in this case, in Canada, well, we're in 2023 now. It's 2.5%. You can actually raise your rents. So we're going to do it at a full-time projection. So we're going to put 2.5% of interest raise, okay? So it automatically defaults to a higher, okay, to the next one up. But now laundry, there's 2 units. I don't even know if there was. I don't think I saw laundry. Was there laundry? Yes, there was. I think there was. Let me just double check. There was laundry, but I don't think it was coin operated. So let's go here. Let's have a double check. It always, there you go. There's the laundry room. And they're not all coin operated. Okay, so they're for free. So which is they can't utilize money off of that. Parking, you're not going to charge for parking. It's 2 units. Pet fees, I always like to charge one. Why? Because there's a lot of people have pets. So let's put in $100. It's $100 a month for pet fees. Usually, in the States, it's very very common. That this is another way of generating income for owners. Okay, one $100 pet deposit fee. So in the event that the dog and again, it's only dogs only, right? No cats, just because if a cat pees on your property or it's almost impossible to get that smell out. Okay, so dogs are relatively much cleaner. So it's only for dogs. So we're going to say one of the units has an animal. Okay, tenants pay utilities. Yes, tenants are going to pay utilities. Always try and get your tenants to pay utilities, even if it's not metered. Try and get your tenants to pay utilities. Energy efficient lighting. There's quite a bit of lighting in the place, but usually when this situation happens, it's usually common areas. So we're looking at 5, 10, 20, 100 units. There's a big, huge common area, and so what we do is we put energy efficient lighting in there, and that's going to reduce it. I don't think we can do anything here. We can possibly potentially change all the light bulbs, but I don't think it's going to make much of a difference. Lower interest rates. So what you're going to do is you're going to just click on that. Make sure you do it. Okay. So you're going to come over here to lower interest rates. Can we lower interest rate? No, we can't. Okay, we're not going to lower the interest rate. Can we increase the down payment? Yes, we can. So you're going to click that and go, okay, well, if we increase the down payment, right? Let me make this a little smaller so we can actually see it on the full screen. There you go. Okay. So actually, let me make this 80 so you can actually see the whole thing. There you go. That's better. Okay. So so that way you can see down here at the right-hand side, the cash flow change for you. Okay. So down payment, yes, we're going to increase it by 30%. Let's say 30%. So 30% is really, you need 214,500 to secure this property, right? Based on the 715 price. So cash flow, we're still in a negative cash flow per year. Okay. Because remember, we have to take in consideration the debt service on this, right? So we're going to scroll down. So we're going to go down to, we've done that. I mean, you can go lower. Let's say you go 40%. Okay, now we're in a cash flow positive. You see what I mean? Like you just have to make a couple adjustments here and there to make sure to see if this cash flows. Okay, so we're gonna go down here, and sure enough, this is our four step cash flow indicator. So basically, we need 4 green lights. We need our deal cap rate to be above market cap. We need a monthly profit. We need a cash flow profit, and we also need a 1% of home rent. So basically, it's a 50% rule. So it's 50%. So whatever it's 1% of the home price. So in this case, it's 715,000. So if we take 1%, it's 7,015. So we need 50% of that rent. And if that is 50% of that rent, and then we're going to get a green light on the yes. Okay. So we get 4 green lights, and it's green. Now, guys, it could be like, one of maybe the cap rate is not above the market cap. That still doesn't make it a bad deal, okay? Or even if, but I think the other ones need to be all green, right? The monthly profit, cash flow profit, yearly profit rather, and the 50% rule. I think it's all imperative, okay? So we're gonna go up here, but do you have 40% down? You're gonna need 886 to put down on this. Not many people have that. You may be able to pull some equity out of your property. That's something that we can talk about. Reach out to me, book a call, and we'll analyze your situation. If you have a home already, you're thinking about buying an investment property, this is an opportunity. Maybe you have the 286 in a home equity line, or maybe we can pull out a home equity line of credit on your property. Grab the 286, and then maybe you can secure this property. Okay, and this is what you're making per year. Now, mind you, this is maybe not something I would do, just because it's a little bit low in terms of the cash flow, but it's up to you. Okay, so now there's another way of improving the property. So let's just put this back to 20%. So we're in a negative. Okay, but now this is where it really gets interesting here, because remember, if you look back here, we put a 10% vacancy. So now look at this. Now we're going to self-maintain it. We're going to say no. We're not going to self-maintain it. We could. It's two units. If you don't live too far from Kitchener, it's probably maybe something you could do. Okay, let's say yes, we are. So if I hit yes, it automatically, if you look over here, it reduced to 5%. It took it right off. So in other words, we're going to self-maintenance. Okay, the property. It's only 2 units. It's not too big of a undertaking. Now this is where it gets really interesting, and this is the rent guarantee programs. There's a couple. I believe there's a couple. I know of one for certain. Guarantee company that basically, if you pay them 5.5% roughly of your overall per unit on your property per unit in terms of how much income it's producing, they will guarantee your income. Okay, so if that's the case and we do that, I want you to see what happens. Okay, so what we're going to do is we're going to put yes. Once we put yes here, if you look here, rent guarantee, it actually put in the 5.5% for you, and it put in, this is what's going to cost you $237 a month in expenses for those 2 units to cover the rent guarantee. So in the event that someone loses their job, a tenant loses their job, they leave, it's vacant, whatever it is, or they're doing something to your property, we can evict them. It pays for lawyers to evict them. Actually pays for even up to $10,000 in damage fees. So, for example, let's say one of your tenants is in the property, they damage it, they leave, that they will cover $10,000 of repair costs. So it's a no-brainer. Okay, it's a thing that everybody should do. So let's say we're going to put that in. So now, if we do that and it's guaranteed, we don't have to worry about it now. We can sleep comfortably at night. We're going to do is we don't need the vacancy, right? So now I want you to look over here. Cash flow negative 5,000. So we're going to take off this 10%. We're going to put that to 0. Why? Because we don't need it anymore. It's guaranteed, right? So we hit enter. So we're still in the negative cash flow of 343. It's not as bad. Now, what about, let's say we increase that down payment again. Let's go up here and we're going to put that, let's say 30%. Now look at that. We're in a $40,000, $4,000 a year cash flow. Now let's put in 40,000 like we did originally. 40% down payment, and that is $286,000. If you can pull that out of your equity in your home, you could be cash flowing $8,815 a year, and now you're securing, close to $750,000 in an asset, right? Now, how about reduced offer price? Why not, right? You never can. You can always ask, right? So now it's 715. Let's put it at 6. Let's put it at 685. Let's see what happens. Okay, it went up to 6 9 just close to $10,000 a year in cash flow. Not terrible. 806 a month. Let's say 650. Remember, guys, when you see a deal on Realtor.ca, they're all overpriced. They're all overpriced, right? So this is the opportunity to put in, especially when it comes to commercial properties. This is the opportunity to make sure that it's this is the opportunity to make sure that it is ideal for who you want, what you want. Now I'm not sure what happened, but my picture of the visual here that I'm recording, it kind of disappeared. So I'm not quite sure what happened, but I'll keep talking in the event anyways. Okay, so I'm not sure what happened, but it did go away. But I believe it's still recording. So let's see down here. Look at that. It's 11,000. So we put in 6.5, 40% down, which is 260, and you're getting 11, just over 11,000 a year, $918 a month. I mean, that could, close to $1,900 a month. That could actually, pay for maybe a part of your mortgage that you currently have right now. Okay, so now this is what is your property really worth based off of the income and your operating expenses. Remember, we only put 25% down. sorry, 25 plus 5.5, so it's actually 30.5% in expenses. Okay, so again, we don't have the taxes. We don't really have the taxes. We average these taxes out. We don't have the electric. We're assuming over here that the tenant is paying utilities, right? We checked it here, which means that we don't have to put these costs in. There are going to be other costs, but remember, we're averaging it out to 25%, okay? Because we don't know those numbers. Right? Once you get into bigger deals, you're gonna reach out to the broker, and you're gonna request that information. You're gonna get a rent roll, you're gonna get expense and P&L and the profit and loss, and you're gonna be able to get those numbers and actually put them in physically. Okay, but right now we don't have it. Okay, so this is essentially what the deal is. So I mean, there's other options. I mean, in this case, I don't think we would go with a vendor take back. You could if you wanted to, but in this case, I think this is good enough. This is actually not bad if you can get this price for 6.5 and you're putting 40% down. Now, this will actually dramatically help your approval, right? If you're putting 40% down. But let's say we don't have it. Let's say we put 20% down. Okay, so you're just about $3,000. Right? That's the difference in cash flow per year. So you have to kind of weigh your options and say, well, is this something that I can do? And again, this is the beauty of this analyzer. You just play with it, play with the numbers. Say, okay, can I do this? Can I do that? So when you're talking to when you reach out to me and we say, let's pre-approve you. Okay, okay. What can you put down? Okay, I can put down 200,000. Okay, so let's see what 25% is, right? 30%. Okay, pretty close, right? So let's say you have 200,000, you want to put 195 down, 30%. I can cash flow it at 7,000 a year, right? And then as the property appreciates, obviously you're going to make more money, right? Because the property appreciates, you're paying down. They're paying your tenants are paying down your mortgage, and that's essentially how real estate works. Okay. So I just want to quickly, briefly. So also here, if you have some things like, for example, let's say you reach out to the broker, and they tell you, okay, what kind of value adds do I need to add to this property? Value adds meaning, what can I do to improve it? Does it need to fix the kitchen? Do I need to replace the floors? That kind of thing. I mean, the pictures look really nice, but again, there's always room for improvement, right? So let's say here you want to, uh, you know, replace, let's say, place floor in kitchen. Okay, so you're just going to say that, and that way you remember what you've spoken about, what you want to do on this property in terms of renovation. But again, so you're going to come up here. If there is a renovation cost, you got to add that here. So estimated cost of repairs. So let's say it's going to cost you 5 grand. It's going to cost you 5 grand to fix those floors. And then you got to add that in. Okay, that's going to take in consideration what your total mortgage amount is going to be and how much you're going to outlay. Okay, so again, this is the specifics. We're going to break down here. This is a general review of what you see above. Cash flow per year, per month, cash on cash return. Your deal cap rate needs to be roughly higher than your market cap. So you actually see how the market cap boosted. It boosted when we actually put in more down payment, right? And reduced the purchase price. Cost per door, which is not very good, but it's relative, right? In terms of the price and how many units. This is what you're paying per unit. So we have a vendor take back section. In this case, I wouldn't probably even do it, but I just want to really quickly just go down and see what the other options you have here in case you want to project what the rent will be if you raise it $50 a month or $100 a month. Now, this really works well on multiple units, okay? These are basically rules of thumbs. Once you put the information on top, it automatically adds it here. You only fill in anything that's blue, okay? Even the text, you can fill it, but only blue. And you're just going to put in here, okay? This is what the average price is. This is how we were able to determine what the taxes and insurance are, right? And it populated on the top there for you to use. You can use it or not. Again, here, this is what basically a 5-year projection return. If you're going to buy and sell, you're going to do the BRRRR method. You're going to do whatever it is you're going to do. In this case, BRRRR method is refi, and you redo it again and again, or you sell it after, let's say, 5-year projection, 5-year parameters. You can change everything in blue here. So if you get a sales commission of 4%, let's say, and then it reflects accordingly. 80% is roughly the refi. You can't, I don't, or maybe even less. It could be 70, it could be 75, depending, but it's not going to be above 80. Okay. You make the adjustments, and in terms of expenses, it's 2% increase, 3% in income, and that will give you a projection as to how much it would be valued at. And if you go up here back under the cash flow, it automatically puts the numbers in for you. Everything's done for you. Okay, the cap rate's put in here. You can see your 5-year cash flow. After 5 years, this is how much cash flow you make based off the 7,000 a month. Sorry, 7,000 a year cash flow. But after 5 years, this is what your income would be. 5-year refi, roughly, okay, 80% of value. This is what you can potentially refi. Okay, this is an unbelievable piece of software or a spreadsheet that allows you to analyze pretty much any deal. Okay, and I've analyzed deals 100 units and above in this, and it works great. So these are essentially the things that you need to actually help a property improve. All right, so reach out to me. Look below, guys. You can reach out to me if you like this property, or if you find a property while you're using the analyzer and you're analyzing other deals anywhere in the States and in Canada. You can leverage my resources and my lenders, and I'll be able to potentially get you some financing for this property. There's a lot of programs for investors, even if you have multiple properties. And there's actually one program that we're working on that I've been using right now, where you don't even have to look at income documents. It's actually cash on cash. So basically, if you can prove that the property cash flows, and then essentially there's a couple other things as well, but it's not too difficult to secure that mortgage. Okay, you are going to be paying obviously a higher interest rate, but that's something to consider, especially if you have multiple properties, because your ratios will be different, right? So once you have more than 2-3 properties, it can be more challenging to secure more investments. Okay, give me a call, reach out to me, book a call. You can reach that link below, and we'll be able to jump on a quick Zoom call, show me what you got, and see how I can help you. Okay, till next time.